Hi everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And boy, do we have a split decision for you today. Today we're diving into a Form 8K filing from FOXO Technologies Inc. Now Form 8K is like a company's quick update report. It's filed when something significant happens that the public should know about. And this one is all about giving their stock a bit of a, shall we say, makeover. So what's the big news here? The company announced a reverse stock split. Now this might sound complicated, but think of it like this. Imagine you have a bunch of small candy bars and the company decides to melt them all down and make fewer, bigger candy bars. They're not creating new candy and the total amount of candy stays the same, but you have fewer, larger pieces. In this case, for every 1.99 shares of FOXO's common stock, they're now becoming just one share. The value of each share goes up, but the total number of shares decreases. In this case, for every 1.99 shares of FOXO's common stock, they're now becoming just one share. The value of each share goes up, but the total number of shares decreases. This change officially took effect at 4:01 p.m. on July 27th. Starting the very next day, July 28th, all trading happened with this new split share count. You might see a new CQSIP number, which is just a unique identifier for the stock, and that's normal after a split. Now here's a key detail. Usually when you do a split like this, some people might end up with half a share or a fraction of a share. Typically, companies will either pay cash for these small fractions, or as in FOXO's case, they round it up. So if you were supposed to get, say, 10 shares, you likely ended up with 11. This is usually done to avoid the administrative hassle of dealing with fractional shares and to ensure all investors hold whole units after the split. So why would a company do this? One of the most common reasons is to boost their stock price. Some stock exchanges have minimum price requirements, and if a company's stock price gets too low, it might risk being delisted, meaning it could be kicked off the exchange altogether. A reverse split artificially inflates the share price by reducing the number of outstanding shares. For FOXO, whose Class A common stock trades on the ANZ American Exchange, keeping the share price above a certain threshold is crucial for maintaining their listing. Their main security called out here is Class A common stock, and it trades under the symbol FOXO on the NYSE American. This is important because being listed on a major exchange like NYSE American generally lends a company more credibility and provides access to a larger pool of investors. This filing also flags FOXO as an emerging growth company. This is a designation given to companies with less than a certain amount of revenue, and it allows them to enjoy relaxed reporting requirements for a certain period. This means they can provide less detailed financial information compared to larger, more established companies. Think of it as a probationary period for reporting. The core of this filing is this amendment to their governing document, specifically their certificate of incorporation. This is the foundational legal document that lays out the rules for how the company is run. By amending this, they're officially making the reverse stock split a reality. This section just details what supporting documents are attached to this report. Exhibit 3.1 is the actual legal document detailing the amendment to their certificate of incorporation. This is the legal proof of the reverse stock split that we've been discussing. And Exhibit 104 is the interactive data file, which makes all this information easier for computers to read and analyze. This is what allows us to quickly pull and process data from these reports. And finally, the report is signed off by Seamus Largan, the CEO. This signifies official company approval. Now, let's talk about what this all means in the bigger picture. Reverse stock splits are often seen as a sign of struggle, not strength. A company usually resorts to a reverse split when its stock price has fallen significantly. It's like putting a band-aid on a deeper issue. While it can prevent delisting and make the stock appear more attractive to institutional investors who might have minimum price requirements, it doesn't fundamentally change the company's value or its business operations. Think about it this way. If a company is struggling and its stock price is low, a shareholder who owned 100 shares at $1 each now owns about 50 shares at $20 each after a 100-2 reverse split. They still have $100 worth of stock, but the appearance is that the stock is more valuable per share. However, the underlying business challenges haven't disappeared. Investors will still be looking at the company's actual performance, its financials, its growth prospects, and its competitive position to determine its true worth. For FOXO Technologies, this move suggests they've been facing downward pressure on their stock price. Without seeing their specific financial statements in this particular filing, it's hard to pinpoint the exact reasons. However, companies initiating reverse splits often grapple with declining revenues, mounting losses, or a generally negative market sentiment towards their sector. The fact that they've chosen to implement a 1 for 199 split rather than a cleaner 1 for 2 or 1 for 3 might indicate they're trying to engineer a very specific stock price. They might be aiming for a price that's just above a critical threshold for their exchange listing, or one they believe will be perceived more favorably by investors. A key risk here is that a reverse split can sometimes signal underlying weakness. If the company doesn't address the fundamental business issues that led to the low stock price in the first place, the reverse split might only be a temporary fix. The stock could continue to decline even after the split, which is often referred to as reverse split hell by market watchers. Investors will want to closely monitor FOXO's future earnings reports and any strategic announcements. Are they introducing new products, expanding into new markets, or achieving operational efficiencies that will drive real growth? That's what will ultimately determine the company's long-term success, not just the cosmetic change to its stock structure. If you're an investor in FOXO or considering investing, it's crucial to do your homework beyond this filing, understand the company's business model, its competition, and its financial health. This reverse stock split is a signal, and like any signal, it's important to understand the context behind it. So to summarize, FOXO Technologies has undergone a reverse stock split, effectively reducing the number of shares outstanding and increasing the price per share. This is often done to meet exchange listing requirements or improve the stock's appeal. However, it doesn't fix the underlying business issues that may have led to a low stock price. The real test for FOXO will be its ability to achieve sustainable growth and profitability going forward. What's your take on this move by FOXO Technologies? Do you think reverse splits are a smart strategy or a sign of trouble? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and make sure you're subscribed for more corporate deconstructions. And don't miss out on our community discussions. Join our Discord server. The link is in the description. Thanks for watching, and we'll see you in the next decode.